Hi, I'm Robert Reeves, and this is The Point. This week we're with Paul Kitney, Chief Asia Equity Strategist for Daiwa Capital Markets, and we're going to discuss the trade war. Paul, thanks very much for being with us.
Pleasure, Robert.
Thank you. Let's begin. Give us an update. What's happening?
Well, I think we're getting close to quite possibly a non-escalation type deal that may come through. There's been some concessions regarding tariffs and intellectual property rights that may lead to a truce, if you like, a non-escalation. Tariffs have been applied to roughly $250 billion at 25% on China, with the threat that would go to 30%. It looks like that may get put on hold in exchange for some concessions, and this may lead to a relaxation of tensions between China and the United States.
Now, it's a little unclear where this is going to be signed or where they're going to meet. It could be anywhere, including Macau at this point, I understand. But it's phase one. And how many phases do we have to go through before we get a final resolution of this?
I don't think there'll be any final resolution on this. I think that we'll see what can be done in terms of moderating the concerns or ameliorating those concerns that the United States has, who have initiated this trade dispute, and we'll see where it leads. It's obviously right now this is something that the markets are very much concerned about. It has had an implication for the real economy as well, because policy uncertainty has been elevated, and that's led to decision makings. Firms have put on hold hiring and capital spending plans. Firms as well as households have made decisions that have been a little bit more conservative than they might have been, which has knock-on effects for the real economy as well as markets. So having a little bit more clarity on the direction of it will be helpful, but ultimate resolution, very hard to say.
So it seems as though this trade war has begun to change global trade and global paths of capital and how capital is deployed. And I'm thinking of value chains, supply chains in China moving out or going elsewhere, Vietnam or the Philippines or Malaysia. I'm also thinking of the effects on the U.S. economy and how the Fed is trying to negotiate that with rate cuts. Could you talk about that a little bit, and are we in a prolonged period of uncertainty as a result?
Right, so in terms of supply chains, yes, they have been disrupted. We have seen production capacity shifts away from China that predate this trade war. So we've done some work on this particular subject. We've done a study of several Fortune 500 global companies, as well as Chinese manufacturers. And there has been a shift to, in this part of the world, emerging ASEAN. Now, in low to mid-level manufacturing, Vietnam is your major beneficiary. In mid to high-level manufacturing, Thailand is your major beneficiary. Minor beneficiaries are Indonesia in mid-level manufacturing, and a minor beneficiary in technology has been Malaysia. Philippines doesn't really fit into it in terms of manufacturing. They're much more of a services base. Same with India, although there's some indications of interest there. But at this stage, the two main beneficiaries, if you like, are Thailand and Vietnam. But the predating of this prior to the trade war reflects cost competitiveness issues. So the wage gap between ASEAN and China has narrowed substantially over the past 20 years. And also what we're seeing is that certain efficiencies can be gained outside of China, and that's why a number of corporations are actually shifting capacity.
How does this affect China, the Chinese economy?
Chinese economy is being unquestionably negatively affected by the trade war. It hurts much more than the United States because its economy is much more dependent on trade than the US, which is much more of a domestic demand-driven economy. So they're being hurt directly and indirectly through not only their higher trade ratio or the value of their exports and their imports relative to their economy, but they produce a lot of intermediate goods. So the actual imposition of tariffs on goods that come into China that are then resold is actually causing them an economic cost. And that's adding up when we look at national income accounting and GDP.
So if this is a prolonged trade war that just drags on in many aspects, that's really going to hurt China, is it not?
Oh, no question about it. And the global economy, and those economies in this region that heavily depend on China, the ones that have a high dependence of GDP to global trade, so Taiwan, Korea, their GDP growth is 90% correlated with global trade volumes. Singapore, 88%, Japan, 82%. And so these economies are very heavily geared into Chinese trade and global trade. Now, global trade volumes have fallen the last 3 months, year on year. That's the first time that we've actually seen this event since the global financial crisis. So the trade cycle itself is already in recession. Now, maybe the global economic cycle is not in recession as yet, but the tradable goods sector is. Global manufacturing, PMIs, without question, below 50, or with one or two exceptions, below 50. So that the manufacturing sector globally is suffering from exceeding amount of stress.
So does this mean that China falls into what you economists call a middle income trap?
So I think in the case of China, it's yet to have made the transition to a consumer or services-oriented economy completely yet. That the Xi Jinping's strategy, which I think is a very sensible one long term, is very much sort of geared towards making China less dependent on the manufacturing sector and net exports, to avoid the type of dependence in an event just like this. Now, they have made strides, but I think that's still yet to take place to the point where there will be much less dependence on global trade than there is now. It's still a major factor.
So someone in the apparel industry was telling me that they are looking at manufacturing techniques that use AI and robotics to actually customize in country. So instead of selling 1 million shirts out of China, you sell 1 million shirts to customized customers in China. Is this in-country manufacturing going to become more of a norm as these trade paths get beaten up because of the trade war?
I think that could be part of it, but in terms of it, the total share of GDP value added or trade value added, it's relatively small, but it's a trend that's likely to continue. But I think what we're going to see is the ongoing shift of production capacity away from China. Now, I think even if tariffs went to zero, which they're not going to anytime soon, even if tariffs went to zero and there was no trade war, and there was no trade war for the next 2 or 3 years, I think the genie is already out of the bottle, in the sense that I think global as well as Chinese manufacturers realize they cannot afford to have all their production eggs in one basket. They need to diversify. And we're seeing this actually in industrial parks in Thailand, in Vietnam, where we're seeing industrial park real estate prices being bid up. Now, I was talking to a global emerging markets expert recently about this particular phenomenon, and he said, yeah, we're seeing the same thing in Mexico.
Mexico, yeah. Okay.
So this is a global thing where we're seeing sort of, the shifting of and the diversification of production capacity that I think is sort of part of an overall risk management process. So
no certainty, we're just going on, stumbling through. Economies are hurting. This program is called The Point. If you have one point about the trade war to leave with our viewers today, what would it be?
Long term, unless it is resolved, it is going to have an unambiguously negative effect on the global economy.
Is that tipping towards recession?
Yeah, so I think we're heading towards that in terms of, I think it's important to understand where we may see recession. I think the global economy is not going to see recession anytime soon. Given that China is going to grow at 5.5% to 6%, India is going to grow 6% plus. They're two major economies in the emerging space. But in terms of the developed economies, the Eurozone, Japan, the United States, they may well face, say, recessionary type conditions, at some point over the next couple of years.
Thanks very much, Paul. And that's Paul Kitney for this week. We're going to be back with Paul in the next episode to talk about more economics. Thanks for watching. Follow us on Twitter, LinkedIn, and Facebook, and let's keep the dialogue going.